Welcome to La Trobe University. My name is Jan Libich, and I'm really delighted to be able to welcome Professor Warwick McKibbin from the Australian National University and a former member of the Reserve Bank of Australia board. Welcome, Warwick. Thank you for joining us.
Great to be here, Jan.
I would also like to introduce my students and thank them for coming. Today we'll be talking about the global financial crisis, and you're very you have an expertise in this area. You've written a lot of academic research on this. So let's start with the causes of the global financial crisis. What's your narrative? What were the main causes of the crisis?
Well, firstly, I don't think there's a single cause, and I don't think there was a single way to avoid what happened. There's been a whole range of different factors impacting on the global economy. I'd probably go back to the Asian financial crisis, 97, 98. And we saw what happened when people lose confidence and pull their money out of the Asian economies, out of Thailand, out of Indonesia.
Was that justified, that kind of quick withdrawal of capital?
Well, ex post it was, because the economies went into deep recession. But I think there was bad policies being put in place. There were bubbles in the banking industry in Thailand, for example. People really didn't have enough information to know which countries were exposed to which sort of problems. But they saw countries that looked similar to each other, and when Thailand went into a crisis, they figured the others are probably going to have a crisis. Now that capital that flowed into the US and Europe and also into Australia was, I think, the next round of problems, because that went into equity markets in the US. It built up the price of .com stocks. We had a recession that came from that in the US largely, and also in Europe. Then the mistakes were policy mistakes. So we had a lot of capital flowing around the world from savings excesses in China and other developing countries. We had the savings moving around the world. We also had a very large relative price shock coming out of Asia, particularly. That is, the price of manufactured goods were falling, the price of energy and mining was rising. That relative price shock and the liquidity shock and the interest rate changes impacted in the US at roughly the same time. So you had a build-up of a structural shock. When the recession occurred in 2001, the Fed cut interest rates to 1%. Which at the time was seen to be a very low interest rate. Today that looks rather high. And then what happened was, because inflation didn't take off, the Fed sat on 1% interest rates for a very long time. Now my view as to why that didn't lead to an instantaneous shift in prices was because of this relative price shock. So the price of manufactured goods were falling, import prices from China. So in fact there was a number of things happening. The key to it was this big structural transformation of the global economy. All the economies in the world were being impacted by this, including Australia, but also Europe. When the Fed responded initially, there was too much liquidity for too long. Now, what that then set in train was through many countries pegging to the US dollar, it meant very loose monetary policies throughout Asia and the rest of the world, and that increased aggregate demand in these economies, and that accentuated the relative price shock as well as inducing an inflationary impulse.
So let's just focus on the Fed's behavior. Does that mean that they've deviated from what should be called the Henderson-McKibbin-Taylor rule? Maybe I should tell the audience now. Not many people know that, but the famous Taylor rule that John Taylor proposed at the 1993 Carnegie conference, Carnegie Rochester. You actually proposed an almost identical rule with your co-author, right?
Well, actually, Henderson and I wrote a survey paper for a Brookings conference the year before that, and the conference asked modellers to model these rules, and John Taylor modelled the rule, and we modelled the rule. So in fact, neither of us should be credited with that rule. It came from Ralph Bryant and Kathy Mann and Peter Hooper. But yes, it is true we presented at the same conference. Ours was a more general rule. What John did was actually calibrate it to US monetary policy to see if he could explain how the Fed had been behaving. It was clever. What he did was clever, but Wikipedia actually has it right if you go and check.
Okay, so has the Fed actually deviated from the original prescription of the rule in terms of the original weights?
Well, you've got to be careful, because the original weights that came from Taylor were the ones that replicated what the US Fed had been doing over the historical period. I actually had another paper in a Brookings volume which was the basis of all this, which looked at what were the optimal feedback rules, not what was the Fed doing, but what should the Fed do. It's very model specific, so depending on the structure of your model and the way people behave, the coefficients can move around a lot. So coming back to the question, the Fed was deviating from the rule that John had written down that replicated the behaviour of the 80s and the 90s. And in my view, it was actually sitting on the board of a central bank looking at what the Fed was doing. I was very concerned because you can't have 1% interest rates in an economy that has, pretty reasonable growth prospects for very long without a massive misallocation of capital. And my concern was 0 interest rates or 1% interest rates, you start getting bubbles in various asset markets.
I actually remember you were one of the first people who were talking about this much before than most of the other people had come to realize that the Fed had been too expansionary for too long in the early 2000s. But now let's go to the other issue you identified, which Bernanke called the global saving glut, the fact that there was just too much saving floating around. I actually prepared a slide, which will hopefully come up soon, which shows the total dependency ratio. So that basically is the proportion of the population that is either people above 65 or people below 15 relative to the rest of the population. And what you see is in the early 2000s, we do see a global trough of that. So basically the proportion of workers per dependent population was the highest, and that means that we did have a lot of savings around. So I think that there is some basis of that. How big a factor do you think this was?
Well,
was it bigger than the Fed mistakes?
Well, the demographics component is what you're talking about, but the whole issue of savings and investment is the key here. So if savings double and investments don't double, then the real interest rate will fall. The interesting question wasn't why just that there was so much savings, it was why was investment so weak relative to the amount of savings that was available. The second issue was this distribution of savings and investment was very asymmetric. So it was China and large developing countries in Germany that were running very high savings rates relative to their investments. Right. It was the US running a very high investment or consumption rate relative to its savings. So these imbalances showed up as very large current account deficits in the US and very large surpluses in other countries. So the phenomena was represented twice. One through the interest rate imbalances, but the other through the current account imbalances. And both of those played a role in the policy adjustment in the US. Fiscal policy is a key part of the story behind here. So again, when you ask, did the Fed get it wrong? It's in the context of what choices they had given what was happening with fiscal policy, and that's extremely relevant today. But back then, I think policy was too loose. As a central banker, looking at what this meant, it meant the Fed was pushing through the global economy a series of asset price bubbles, as well as potentially down the track, very high inflation, which as a small open economy, we would have to deal with. And with an inflation targeting central bank, it's very hard to keep your inflation rate separate from the world.
Well, we will certainly talk about monetary and fiscal responses to the crisis and some of the lessons we can learn from it. But let's just look at how these low interest rates that were due to this, as well as the other factors you mentioned, how they affected the housing market, which is considered to be the trigger of the crisis. So we've got a famous, the next slide will show the famous picture from Bob Schiller's Irrational Exuberance book. And what it shows is the real house prices, average house prices of an existing dwelling in the United States for the last 120 years or so. And what we see is that generally, house prices do fall and stay lower for significant periods of time. But the boom since the early 1990s is kind of really unprecedented and quite extraordinary. So the question is, what was it just the issues we identified that were driving this boom, or were there other? Well, maybe let's look at it at the international perspective. Let's look at the next slide now to just see that this housing bubble was not unique to the United States. So what I did, I put the United States. This is data from The Economist, but I also put a few other countries: Australia, Ireland, South Africa, Spain, and the UK. And we're normalizing it from 1999, and I always let my students to actually guess which one's the US bubble. If you wanted to have a guess, you can. But the next slide will actually give the answer. So let's go to the next slide. Yeah. We'll see that the US bubble was actually much smaller than some of the other countries. So why is it that housing markets are such a mess, that we see bubbles like that?
Well, you've got to be careful because there's two sides to the market. There's the supply and there's the demand. In the Australian case, there is actually quite a significant insufficient supply of housing, and that's regulatory. That's to do with planning and state government regulations and local councils.
But that's quite unique to Australia.
It is, but
most countries don't have.
You have got, so when you have this liquidity in the system and you have people buying assets because they're trying to get a rate of return on these assets and they expect prices will rise, then they will continue to buy until the price stops rising. Some of these I would regard as bubbles. Some of them are a transformation and adjustment because remember that this is the period, this starts at the beginning of a debate about how the world had changed and that we were now in a new world order. And
with higher productivity.
With high productivity, with low inflation, the central banks of the world had done their jobs and now we're in an age of great prosperity. Now, if you're in an age of great prosperity, and this is particularly true for the Australian debate, what should you do? Well, you should increase your consumption, borrow against those future income gains, take that consumption and don't necessarily consume it all today, but create assets that give you a flow of consumption over time, higher than otherwise. And so in the Australian debates we were having at the central bank, the question was we were seeing in the demand for housing coming from a bubble, or was it actually fundamentals because the potential income of Australians had jumped so much because of the China boom? This was quite a rational allocation of resources.
So you're thinking like a jump to a new equilibrium, basically. So in that case, you could maybe rationalize this increasing slope just because you need to get to the new equilibrium.
That's right. So if you believe that consumers are consuming based on their expected future income, you change the growth rate of income by just a small amount, and the present value of the future is a very big number. And so you couldn't ex ante say there's definitely a bubble there. You could only say, well, let's look at other factors and see whether we can see if the fundamentals are consistent. So not just look at housing, but look at other types of asset classes. Was there a misallocation of resources? My view in the Australian situation was we couldn't see one except 2006, 2007, I was very concerned that housing prices were rising too quickly. And you'll notice that when the bank did raise interest rates, the housing price market just levelled off for a number of years. The Fed, for example, though, just stayed there and prices kept rising and rising and rising. And the argument in the US was this is a new era of productivity. The lower prices we're observing were really productivity boosts in China, not productivity boosts in the US. And so I think that was the fundamental mistake.
Well, some people would argue that a part of this story is certainly the push of politicians for affordable housing. And we saw that a lot in the United States. We have the government-sponsored enterprises that played a big role in mortgage securitization. We also have various other implicit guarantees and so on. So what's your view on this Community Reinvestment Act?
Well, I think they all played a role, and this is the trouble with trying. Everyone wants to point to a simple cause, because if you can find a simple cause, you can then advocate a silver bullet solution. And politicians in particular like to be able to say, this is how you fix the problem. My view is that the world is far more complicated than that. And to fix this problem, you needed to not only change the way in which the financial industry was allocating capital, but you had to change interest rates. And again, come back to this fundamental question, is a normal economy with reasonably low unemployment and very good growth prospects, is it sensible to have an interest rate at 1% or a real interest rate which was possibly significantly negative? And the answer is no. And that's the problem you have actually when you hear the debate and you in the media about what will the Reserve Bank do at the next meeting or what will the ECB do, is they're not focusing on the level of interest rates, they're focusing on the change. And they say, should rates go up or down? My view is always, what should the interest rate be in Australia today, given the state of the economy? And if where we are is a long way from where we should be, the fact that we might have got a bit of data that caused us to be concerned that we should cut rates is really not the driving factor. It's how far have you deviated from what would be a sensible policy? And right now, interest rates in Australia, if you came from outer space, you would say interest rates in Australia look remarkably low compared to any sort of natural equilibrium where capital is being allocated efficiently.
Okay. So going back to these GSEs and so on, they seem to have contributed through the mortgage securitization. They had some tax as well as capital requirements advantages, and there are many people who argue this. And this is why the US housing boom seems to have started in the mid-90s, where Congress was kind of increasing the quotas that the GSEs had to allocate to these low income people. So do you really, is there much relevance to this explanation other than what we've just discussed?
Well, again, there are so many factors. If you had closed that down, if you could repeat history and not do that piece of legislation or that policy, you'd probably find, given the impulse from the fundamental shifts in the global economy, that you would have ended up in the same sort of situation. The trigger might have been different. And that's the key, is you can't predict that there's going to be some particular trigger. But if you're in the middle of a very high fuel situation and someone drops a match or someone does something, everything's there to blow. And that's what happened in this case. And you could also point to the securitization issue, that there were lots of assets being bundled and people were misrepresenting the risk by creating these new assets. Now, why were these assets being created? Partly because the search for yield, because interest rates were so low.
The demand was there.
So there were so many things that were happening. And you know, as an aside, this is where institutional structures and good policy makes a big difference. You don't know how bad a policy is until you push against it. And so once you get these big shifts in either relative prices or interest rates or exchange rates, that's when you can tell whether or not you've designed an economic structure that's robust. And we're seeing this now with the mining tax. So you design a system that might work in a particular world, but when China stops booming and there's no revenue, the tax is zero, but you've now allocated all the revenue already. That's really bad policy design, because it assumes that you are actually, the policy you're designing is going to work the way you plan it. And in most of those countries that have had problems, all the problems they've had have been because of some other change, it's for some other reason. But as soon as you push up against it, that causes the stress and the distress amongst the population.
So the narrative of many of the European Union leaders who say, well, you know, the crises have really come from the United States, and you know they should kind of clean up the mess, and it has nothing to do with us. That's probably not an accurate description. But let me just go back to the many people talk about the too big to fail problem, and you talked about the institutions being really challenged only when you press against them. So up until the problem started, we didn't really realize how big a problem it may have been. What role did this play? The fact that, you know, these big financial companies have an implicit guarantee by the government.
Well, again, that was a serious problem, because it led to a set of incentives amongst managers of these corporations to behave in a particular way, assuming, in fact, that the government would bail them out. When Lehman's went down, that was really a trigger, because it sent a signal to people that, in fact, maybe the government won't save these big institutions. Now, my view is that these institutions shouldn't have been allowed to grow as big as they did. The breaking of the Glass-Steagall Act was really one of the key mistakes that was made, amongst many. And I think having these very large institutions lead to systemic risk that you don't necessarily have to have. But it's easier to say that now. The question is to act before this becomes a problem. And that's the big issue, I think, for many policymakers around the world.
But many countries don't have this separation of investment and retail banking, including Australia, and it seems to be working okay. We don't run into these kind of
Well,
problems.
again, we have a different regulatory framework. So the work that APRA does in Australia is a very different sort of regulatory intervention than what the US equivalents do in the US. Again, and Australia is a smaller economy. In the US, it's a much larger scale, so it's much harder to do the regulatory framework in an efficient way. But I think, again, yes, you can point to that. But again, if we had not had that particular financial system in the US, we still would have had the sort of problems that we've seen. For example, we see that in parts of Europe and in other parts of the world where you push up with a global trade shock, push down world interest rates, and all of a sudden all the fragilities in those economies start to stand out.
You mentioned regulation, so let's talk about excessive leverage. Is there anything, you know, what kind of regulation should we have? Is Basel III, for example, going in the right direction? Is it sufficient to alleviate some of those problems?
Well, as with everything, a lot of these international agreements are actually driven too much by politics. So, for example, in Basel III, there's a debate about the European countries in particular want government debt to be included as a risk-free asset in the calculation of risk for Basel III. Now, they want that because they need the demand for government debt to rise, because a lot of these countries are producing too much. In Australia, we couldn't reach the proposed levels that the Europeans want on the balance sheets of our financial entities because we haven't got enough government debt. So again, the principles of why you want to do this are good principles, but the implementation is ultimately driven by politics in these international negotiations. And that again is a bit of a concern.
So if you had your say and if you could just do it based on the economic merit, what kind of regulatory framework would you put in place to limit this excessive leverage?
Well, firstly, the question is it excessive leverage? If you go back to my argument earlier, if you're looking at a new world where inflation has been eliminated and 2 or 3 billion people are entering the global labour market and there's a massive global transformation going on, if you're an individual consumer, possibly you should be leveraging because your future wealth will be so much higher than your current wealth, so you should bring that forward. So you've got to identify in any of this what the fundamentals might be and then what's excessive. And that's the first thing. The second thing is then to say, well, what sort of policies can you use to slow down this accumulation of leverage? One way is to regulate the lending of institutions. Another way is to use interest rates from the central bank. That's a pretty heavy tool, but use interest rates to get people to pull back. There's a whole variety of different techniques, but the key issue here is how much is excess and how much is not excess. You've got to think, for example, the terms of trade shock that Australia has been experiencing, that was going to eventually level out and not disappear necessarily, but it was going to come down. In that environment then, it did pay for Australia to probably be a little bit less leveraged, for the government to be a lot less leveraged, for us to have a sovereign wealth fund so that we could push offshore some of the benefits in case we needed them later. That sort of risk management, I think, is the best way to design policy.
But I mean, I agree with you that individuals can leverage against their future income, but is it a good system that we have banks basically leveraging so much and gambling with taxpayers' money in effect, because they have limited liability? That's the key.
Well, again, the question there is, are they doing too much? It's good. It's just, I mean, capitalism works because of leverage. You take someone who's willing to take a risk, you invest that in some activity, some of them will pay off and some of them won't. Now, the trouble we have in the last decade...
But you can do it with no leverage, right? You can just
you can do it with no leverage
and lend it out.
You can, but if you leverage up, then there's a chance that, in fact, in a world where there's all sorts of productivity inventions, etc., then taking risks like seeding Microsoft or Apple or one of these, the payoff is enormous. So I don't have any problem with leverage per se. I think the problem is that if you create a system where people taking risks get the private benefit, but the government takes the public cost, then you create a very dangerous system. So it's not the leveraging that's a problem. It's making sure that if someone takes a leverage position, that they're the ones that pay the price, or the lender shares in the pain if it goes wrong. But we have a system, we created a system where people could take risks with other people's money, and you don't even know where that pool of securitized assets have come from. And the lenders themselves don't take a haircut when things go bad. That, to me, is more important.
So how do we change this? How do we stop? You mentioned one way is not to let these financial companies grow so big so that they're so important to the financial system. Don Brash, the former governor of the Reserve Bank of New Zealand's got and who we interviewed here last year, he's got an alternative suggestion, meaning that the institutions that are too big to fail, we have to explicitly acknowledge that, and they need to somehow compensate the taxpayer for the implicit guarantee. And other institutions that are not too big to fail, we are explicit about never bailing those out. Would that be a feasible
That would be
solution?
a very feasible situation. And it's not just the too big to fail, it's also that we have in Australia, we have banks who have implicit government guarantees, which means that they are getting funds cheaper than otherwise would be the case, competing with smaller financial institutions that don't have that implicit guarantee. That distortion needs to be rectified, and they need to pay a premium to the government for the fact that they're getting this sort of overarching guarantee, implicit or explicit.
So let's move from the causes of the crisis into how it propagated. Our starting point is the fact that we ended up, especially in the United States, we end up from going, say, 4% subprime mortgages in the mid-90s to about 20% subprime mortgages in the just prior to the crisis. And we identified the factor why that happened. So how did this spread to the rest of the real economy as well as other countries? What was the mechanism?
Okay, so in 2006, Andy Stoker and I wrote a paper called The Collapse of the US Housing Market, where we took one of our models and we modelled what happened if the bubble that was in the US housing market collapsed. And what we found in that analysis was actually the US would go into a recession, but the rest of the world would actually just have a little mild downturn, and the capital reallocation effect that we had observed in Asia in 97, 98 would also occur for the US, and this capital would flow to the rest of the world. And the US would have a period of slow growth, but the rest of the world will get through it. Now, what was wrong with that analysis, or why that analysis wasn't correct, was the real effects we captured. What we didn't capture was the financial impacts, firstly by people changing their perception of risk. So when you throw in subsequent work, we've thrown in what we observed in different financial markets in terms of changes in levels of risk. And we found that if you increase the risk premium in a consumer's mind or in a corporation's investment strategy, a small change in risk means that the present value of the future returns from your investment will drop dramatically. So those wealth effects and those investment effects are actually very negative for the real economy. The third issue was that because the financial institutions in 2007, 2008, because we had no idea what the linkages were, and even sitting on the board of a central bank, we had no confidence that we knew what was happening in terms of who owned who what. That seizing up of the financial system was an additional shock, which meant that there was no financing for anything. So banks at some point weren't even lending to banks. Now, once you do that, that brings the entire financial system down. And if you do a shock like that in our sort of models, that's the Great Depression. So there's a series of subsequent shocks. Now, the most persistent shock, which we're still experiencing, is, coming back to your original point, was that a lot of individuals and corporations had leveraged a lot. And because of this new world order with higher risk, the leverage ratios were too high. And so people had to deleverage. And once you start deleveraging and everybody's selling their assets, then the values of these assets are collapsing. So the third round wealth effect of deleveraging is large and very persistent. And so right now the key for any of this is not to have, to keep nominal growth, nominal GDP growth high as possible in these economies. And that might mean with low real GDP, get inflation up. Because if you don't have that, if you have deflation, the real value of all these debts will be escalating. And that's a recipe for a Great Depression.
This is basically Paul Krugman's argument. He's saying, well, if the private sector is deleveraging, we need the government step in and basically compensate for that by a fiscal expansion. Obviously, the problem is if you already in a very difficult fiscal situation, you cannot do that. So that brings us to the policy responses to the global financial crisis. Let's start with monetary policy. What were the responses, and what's your kind of assessment of whether they've been effective?
Well, there have been very different responses in different countries. What we did in Australia was, despite a lot of people saying we should follow the US with interest rates going to zero, I had a very strong opinion that once you get away from an interest rate around 3 or 4%, you're misallocating capital. Secondly, the shock we were experiencing is a very different shock to the shock that was being experienced in Washington and in London. And the big problem was that all the policymakers were meeting in these places that were going through a financial crisis and were coming up with solutions which for them was their solution, but which they wanted the rest of the world to stimulate as well to help carry them out. So the analogy would be, if we'd gone to Jakarta or we'd gone to Bangkok in 97, 98, the policymakers there would have been advocating a totally different set of policies than what the IMF was advocating, because these countries' self-interest is to have the whole world stimulate them. And it's the case for the US and Europe, and the IMF were part of this, was they wanted countries around the world who weren't even in crisis to stimulate their economies, because we know fiscal policy alone doesn't have much of an effect in an open economy. If you do a fiscal stimulus, you get a stronger exchange rate, you get higher interest rates, you get a crowding out of exports and investment. And so in the Mundell-Fleming model, you get very little effects of fiscal policy. But if the whole world does it together, you eliminate the exchange rate effect. And so you can actually stimulate the global economy if everybody does fiscal policy together. Now, that's still Keynesian economics, but that's in a real Mundell-Fleming world with capital mobility. And I think that was the mistake, was that countries stimulated everywhere, and then all of a sudden they didn't have a mechanism, except in one or two places, to get the future debt to GDP ratio back down again. So we see that in the US, we just had a 10 to 11% of GDP budget deficit with no credible policy on how you're going to bring that back in the future. Now, once you have that problem, then you have a big problem with people's worry about future debt, future tax liabilities. If you're worried about future taxes, you don't invest, you don't save. So there's a real problem that the lack of a future strategic policy position meant that the fiscal guys really damaged the global economy. And what you could do with monetary policy in that case is very little, because monetary policy doesn't create stuff. Taxes destroy things.
You can print money.
Print money, and all that does is shift spending from one period to another. So if you print money today, all that does is bring spending from the future to the present. But very few people, well, some people may, but most people don't believe that monetary policy builds things. It can help smooth business cycles, but it doesn't create a whole new world where everybody's better off. And this is the fallacy, I think.
Well, some people would argue, as being the devil's advocate, that the fact that the global economy, and especially U.S. economy, is so weak is a counter-argument that, fiscal policy, we haven't had enough of that. It wasn't strong enough. And that's why in fact, we have another slide looking at so this is looking at the employment after the recessions in the United States, with the red one being the current crisis. And what we see is that generally, this recession has lasted much longer, and the employment effect compared to all the other recessions in the United States is much deeper. So that would be a counter-argument. People would say, well, we need more fiscal policy to get out of this.
Yeah, so the problem with this argument is American economists who make it only ever look at the US. And one of the advantages in living outside of the US is that you know that there are 240 other examples of different countries that do things differently. Now, if you look at what happened in the UK did a massive fiscal stimulus. Did they end up any different to this? No. So to me, it's not the scale of the fiscal stimulus. What this is reflecting is that from the mid-90s right through till 2007, US should have been following some fairly substantial structural adjustment policies. Low-skilled, white males, mostly, should have been losing their jobs. Instead, the government was continuously trying to pump up the economy so that the building industry survived, so that the motor vehicle industry survived, when they could not compete with what was happening in China and India and America. So this structural problem was getting bigger and bigger and bigger. When the confidence effects hit, the structural problem was there. Now, you don't fix a structural problem by pumping in government spending. What you do is you have to invest in a whole long-run retraining. You have to have efficient industries created. You have to let things be more mobile and flexible. Real wages have to fall in some sectors of the economy. That's what should have been happening. Throwing fiscal policy on top of that when it's not a demand problem, all it does is it creates a lot of debt, creates a lot of tax liabilities, a lot of uncertainty, a lot of political frictions. And in the case that we're seeing in Europe, if you have a fixed exchange rate as well, it creates a really, really seriously flawed economic system which has social ramifications, which has nothing to do with the fiscal policy. Now, what I think the mistake in the US was, they did enough fiscal stimulus, but they didn't have a plan for the recovery, so their future debt liabilities were not controlled. That's what's overhanging the world now, and it's the same in parts of Europe. In Australia, we did it the right way in the sense that Treasury managed to put on the table a policy of a stimulus with a very clear profile of reduction. The only problem I had was that the stimulus was far too big. We could have done half the stimulus with the same phase out, and right now, we wouldn't be having the debate about having to run a budget surplus by 2012, 2013. So we were probably the best of all the countries, but we still didn't get it quite right.
I think there is a lot of evidence about what you're saying, for example, in terms of education in the United States getting worse, and also about the comparison, international comparison being important. The next slide actually shows the perspective. So the red line is still the United States employment in the current crisis, but now we're not comparing it with the other recessions in the US, which were of a very different nature. They were not induced by a financial crisis, but here we're comparing it to the other countries that experienced the financial crisis. And this is the Rogoff and Reinhardt kind of story. Financial crises are costly in terms of employment. So the US situation actually doesn't look so bad from this international comparison. So the previous slide really kind of mixes apples and oranges.
Yeah.
Would you agree with this?
No, I agree with that. And the US is actually doing quite well at the moment. There are some issues. There are some demographic factors. Coming back to your question on demographics, there are a few demographic factors that are disguising what's happening in the US economy, particularly where it regards participation rates. And so that's having some impact. Japan is a clear example of that. So anything you put of Japan, it should always be per capita, because the demographics in Japan is such that people say there's 2 lost decades in Japan. from the 91 crash. Actually, there's only one lost decade because in per capita terms, Japan has been growing faster than most of the other industrial countries, but their labour force has been falling very quickly. So you've got to be very careful with these cross-country comparisons. But come back to your point, yes, the US is a middle ground. The reason for the problems we have in Europe is because they have a series of other problems, structural problems, largely related to the fixed exchange rate system and the lack of any institutions to support that, which are going to make the situation in Southern Europe in particular, far worse than the US.
Let's move kind of and look ahead a little bit about the challenges. And the next slide is actually looking at the balance sheet of the Fed as a consequence of all the actions that they've done in the last few years, and it's basically tripled. And the mortgage-backed securities, the grey area is the big increase. But we also need to see the blue area. That's the holdings of U.S. Treasuries, and we need to acknowledge that the portfolios changed dramatically because they used to only hold short term, because now it's it's basically the long term securities. How is that going to be kind of wound back? And do you think this may potentially be inflationary, as many people fear?
So I use a very similar slide in most of my presentations, and no central bank has ever been able to turn something like this. We have no example of a central bank turning around a balance sheet in the way that's required. My view of this situation is it's probably doable, but why is this not causing inflation now is the first question. And that is because even though you've expanded the supply of money dramatically, you've also increased the demand for money dramatically. So people don't want to hold certain assets, they're just holding money because they're worried about a big crash. Now, they can do that. Money's okay to do that when you have low inflation, but as soon as you start getting some inflation information which suggests that inflation's on the rise, people will start to dump their money balances. They'll get into real assets, they'll get into gold and other. When that happens, the Fed has to be ready, and the other central banks who have done this have to be ready to contract their balance sheet, because if they don't, if the demand for money crashes and the supply of money is extremely large, that's very, very inflationary. Now, I don't think this is hyperinflation. I'm not saying we're going to have 50% inflation, but realistically, what the Fed should have done, as well as some of this activity, they should have announced an inflation target of 5 or 6%. If they had announced an inflation target that was credible and started buying up the government securities at the time, so people said, these guys are trying to have inflation, they're acting like they're trying to have inflation, maybe they are going to have inflation, real interest rates would have fallen far more than in fact they did, because people were worried about future inflation. So people were worried about what was the Fed doing, what was the policy. So I think they made the same mistake as the Japanese made, and the Japanese should have increased inflation as quickly as possible, got their currency to collapse, and that would have stimulated the economy, and that's what the US should have done very, very early on.
So you're saying this would have been a lot more effective than the kind of quantitative easing and other unconventional policies that they've pursued?
Well, I think the quantitative easing, you needed some of that. But the way you did that was to announce an inflation target, a reasonably high one. And I think I wrote about this quite a few years ago, that you needed to get inflation up. What you wanted to avoid was people thinking inflation was going to go negative, because if inflation goes negative, the real interest rate is positive, no matter, even with a zero nominal interest rate. That was the problem. I don't think they've done it in a way which is credible.
I think this is the Woodford-Egerton story. They're kind of arguing the Fed should commit to being irresponsible and promise to leave rates at a low level for a very long time. Although I think yours is slightly different in terms of the.
Well, it was quite interesting because I was heavily involved in the Japanese debate. I was working with the Japanese Prime Minister's office for quite a while back in the 90s. And all the American economists that came through the door were saying to the Bank of Japan, you should announce an inflation target, you should have a high inflation target, and you should debase your currency. It's easy to debase your currency, you just print as much as you need to. And the Japanese were saying, no, we don't want inflation to get out of control. Now the Americans are doing the same thing, and it's got to be mostly politics.
Yeah, it seems like, Bernanke was a big proponent of inflation targeting before he became chairman, and everyone expected he would go ahead and do it. But yeah, there must be some political constraints. Now we're kind of rapidly running out of time, so let's quickly look at the fiscal outlook that you already mentioned. We've got a slide here that's looking at this is the Congressional Budget Office prediction of the debt to GDP ratio in the United States. And I should say the blue line, which they for some reason call alternative scenario, is actually the one with the most likely assumptions that they themselves say it's the most likely. So what does this tell us? Is this, how long will it take before the markets start realizing that there's a serious fiscal unsustainability problem in the US?
Okay, so I actually worked at the Congressional Budget Office for a while, and I'm still involved with them. What the alternative shows is the current policy settings, what will happen. And so it's not really the most likely, it's if nothing changes. Which
seems most likely politically in the United States.
Well, this is a real worry, and actually this feeds back into this inflation issue, because if you look at it, US liabilities to the rest of the world are all in US dollars. And if you look at this, how much government debt there is and who's holding it, the simplest thing for the US to close its budget deficit is not to raise taxes because of the politics, not to cut spending because of the politics, but high inflation has solved many fiscal problems for many countries over the century. So the US has the incentive, when you look at this, to have high inflation. The Fed should have taken that into account and announced higher inflation, not very high, but enough to get the economy moving. This is a real problem, and I don't see it being resolved next week, when the presidential election is held, week after next. It's not going to go away, and there's a fiscal cliff coming in January, which actually is quite a dangerous thing for the world economy.
Now, I should mention that this similar problem is in the pipeline for most other countries, so it's really a global problem. But before we hand it over to the audience to ask questions, I just wanted to maybe summarize the lessons that we may have learned from the crisis about regulation, about monetary fiscal policies, any kind of crisis that any kind of lessons you might identify, and whether we've really learned them and whether we're changing things to the better.
Well, the first thing, come back to the monetary policy rule. The original paper that Henderson and I wrote when we were comparing inflation rules, nominal income targeting in that paper in the empirical work was better than inflation targeting. So my view is that central banks should be targeting nominal income growth, not inflation. Now, the reason for that is that if you get a shock like we're observing now, even if real output falls, people are then confident that the inflation rate will rise, and that'll avoid the debt deflation dynamic. So there's a lot of reasons to switch our arguments on monetary policy.
You lose the anchored expectations kind of feature that was one of the main benefits of inflation targeting.
That's the argument. Although I would argue, and I've had students doing PhDs on this, is which is easier to forecast, nominal income growth or inflation? And if you look at the evidence for the US, it's better. You get a better forecasting rule on nominal GDP growth than you do on inflation. So therefore, I disagree with the argument of the anchor. The anchor on nominal GDP is just as real as the anchor on inflation. And in fact, nominal GDP is something you measure. Inflation is an index that you create by putting together a whole bunch of data. So we could have this debate. I won't do it now, but there's a lot of papers from the 80s looking at nominal income targeting. That's the first major lesson. The second lesson is be very careful what policies you put in place. For example, on climate change, if you don't look at what that means for these other shocks that are coming through the system, that's a big deal, because some policies like climate policy changes the propagation mechanism, and when you push up against it can create very, very bad negative impacts if you haven't got the policy right. The third thing is institutions matter a lot. You've got to design your institutions, political institutions, to stop politicians from making major judgment errors, and economic institutions like central banks, independent budget offices, productivity commission type evaluation of alternative policy institutions. Those institutions should be set up in the good times, so when the bad times come, you don't get irresponsible policy by governments.
And I think the reforms in Europe now show that everything's done under pressure, and that's why
it's the worst time to do it.
So can I turn to the students and maybe request some questions? Andrew?
In almost every interview post-GFC, the question comes up about regulation. I was wondering, what do you think, if there's a case for more regulation in the financial industry at the moment, or less?
Oh, I think better. Markets unfettered do not work very well. Regulation that's really bad is probably even worse. And so the idea, the principle should always be not that we shouldn't regulate, but what's the best way to design the regulation so that the incentives of everybody in the marketplace are aligned to the social good. That's the principle. Now, it's easy to say that, it's harder to work out how to do it in specific cases, but there are some glaring holes in the US. You could see the incentives in the financial system were really poorly structured, and the regulatory frameworks just couldn't deal with them. And you see that in many circumstances. It's always easier though to look back and say, wow, how did we do that? But I think those principles should be the core principles.
So just to follow up on that, there seem to be these two camps. One says that the GFC was primarily a market failure, and that's why we need more regulation. And the other camp says, well, it was mainly, a government failure, and we need less regulation. So you'd be somewhere in the middle.
Well, my problem with that, Jan, is that I think that simplistic idea that we see that comes out of 30-second grabs in the media is just too simplistic. It's wrong. The world is complicated. We're talking about mostly people's behaviour, psychology. We're talking about people, how they interact in markets, etc. I just think those simple things are too simple. You have to sit down and look, and that's where I think behavioural economics is teaching us a lot of things, is you have to see how people behave. How do you structure something to capture the real behaviour that we observe, and design over time and evolve. The other idea that I think is wrong is that we know everything now and this is what we do. It's again coming back to the climate debate. The argument is we know the science, we know that we've got to stop this thing. I think that's completely the wrong way to think about climate change. What we should be dealing with, how do we manage the risk? The risk of the policies, the risk of the climate change on the society. It's a risk management question, and that designs very clever policy, that requires very clever and adaptable policy as we get new information.
And I should say that you take the complications of the complexity of the real world very seriously. I remember when I was starting my PhD, I first came across your big model, which you had mentioned previously, and which many institutions, I think, including the Fed, are using. And when I heard it had 6,000 equations and
15,000 actually.
Now 15,000. Well, I remember it really gave me kind of goosebumps about just economics being way too complicated for me to absorb. But that model really can capture at least big chunks of that complexity, hopefully.
Well, it's very simple compared to the real world, and the only reason that it's so big is that each little bit we think we understand, we model, and then when you put it all together, the interaction of all the bits is too hard to do in your head. And although my co-author, Jeff Sachs, who was with me the very first time we built one of these models, he seems to be able to do it in his head, but no one else can. And given he's not running the world, then you need to build these models so that policymakers can understand all these linkages, because it's very complicated.
Okay, let's have another question, if there is anything. Chris?
You spoke before about America trying to inflate themselves out of the problem. How do you think China's going to react if America starts printing off money and trying to kind of inflate away their debt? Are they going to just drop all their money and get rid of all the bonds they own?
So there's two sets of questions. The first set of questions is answered from what we observed from 2001. So as the US was expanding liquidity, the Chinese were worried about losing competitiveness, and so they pegged their exchange rate, which meant effectively they also expanded domestic liquidity. So on the real exchange rate story, they're going to try and peg against anything the US is doing. And that's why I think the inflation impulse from the US, when it begins to feed through, will feed through very, very quickly, because not just China, but all of Asia, Latin America will peg so that they don't lose competitiveness. The other aspect of your question is the Chinese are holding a lot of the US securities. And if there's high inflation, they're going to actually lose value. And we've already seen many central banks actually have changed their portfolio allocation. It's not that they're dumping US dollars, but what they're doing is they're diversifying. So they're now holding more Australian dollars, more Swiss francs, more Japanese yen, and they're keeping their US dollar holdings roughly constant, so the share is falling. But if you do get a concern that in fact the US is going to really go down the road of inflation, you will have this problem of dumping currency. And we modelled this for the World Bank last year for the G20. We took one of our big models and we said, what if China all of a sudden just sells all their holdings of US securities? And in a model you can do that. What it does is it actually drives up real interest rates in the US by about 400 or 500 basis points, and it causes about an 8% decline in the US economy in that year, because they're holding trillions and trillions of dollars. And it's not just paper, it's actually real assets that when you dump them, the prices fall and the interest rates go up. And so you hope you don't see that scenario, but it's a very dangerous situation for the US to contemplate, because they're not a big closed economy anymore. They're less than 20% of the world, whereas they used to be 50% of the world. So they're playing in a game that Australia plays in. That is a medium-sized economy that's open to the world and whose outcomes depend on what happens in countries like China and Brazil and India. And that's dawning on America now, but it's actually a serious problem with some of the economic I mean, well, Jan, you know, many of the models that people use for monetary and fiscal policy are closed economy models in the literature. Well, that's crazy. There's no closed economy in the world except North Korea. But, you know, it's a very dangerous... well, yes, there's a few. But it's a dangerous mindset because you're working in an analytical space that's not actually mapped onto the real world. And sometimes the exchange rate matters, and sometimes oil prices set outside the US matter. And sometimes people get it wrong because they can't see that. And that's why I think the Fed got it wrong in the 2000s, because they didn't see the relative price shock and the low manufactured prices coming out of China as anything relevant for the US economy.
You have an interesting suggestion in relation to the trend you mentioned, that other central banks are buying Australian dollars for their portfolios, which tends to appreciate the Australian dollar and you know, hurt our exports. So you're basically suggesting that they should we should be selling the dollars to them directly, the central bank, rather than going through the markets. Can you just outline the reasoning behind it?
Yeah, so this created a lot of problems because I had union leaders coming out and saying that they agreed with my proposition. And I wasn't saying that we should control the exchange rate at all. What I was saying was, if a central bank wants to hold Australian dollars, we know that's a shock because they've announced it. And if we can take that shock out of the market, we should. So we should print the Australian dollars they want, give it to them, and therefore the exchange rate won't move. And they'll get their preference. We'll get the scenerage from them holding our currencies. And then you can worry about the strong currency coming from other factors. So it's a very small effect. In fact, it may well be the exchange rate doesn't go down at all as a result, because I'm not targeting an exchange rate. What I'm doing is saying, well, give them some reserves, they want them. Now, that's very different to should we intervene in the foreign exchange market to peg the currency like the Swiss do, and I don't think we should, because the flexible exchange rate is such an important part of our success that what we need to do is, and again, Jeff Sachs and I wrote a number of papers in the 80s about optimal degrees of intervention. If you can identify the shock, you should hit the shock rather than offset it in another market. If you can't identify the shock, then you have to sort of be very careful. But pure floating exchange rates without any sort of ever a dealing with a particular shock is actually not the optimal outcome if you know what the shock is. If you don't know the shock, then let the market sort it out for you.
Well, I guess now we have a lot of evidence that flexible exchange rates are very beneficial. Many European countries are now learning the hard way that being in a common currency area is very costly, in the sense that you lose one of the main adjustment channels, countries like Ireland and Spain. And if the ECB, really insists on having a 2% inflation target rather than raising it, as many people propose, that's going to mean that Ireland and Spain and others might have to experience, wage deflation and so on. So that might be very costly. Are there any, maybe just one more question, Selena?
I'm just wondering if you think that the U.S. actually will be able to work their way out of the situation they are in now, and if that will sort of cost them their role as an economical leader as they have been in the past.
That's a very good question. Economically, it's fairly straightforward. If economically they were willing to deal with the fiscal problems they have by cutting some spending and raising some taxes and having higher inflation for a short period, the economics of that is pretty sound in my view. Americans are incredibly productive. There's a lot of innovation goes on in the US. This is a very flexible economy. You give them the right incentive and it will generate what we observe around us in terms of most of the technology on the planet. So I'm an optimist. I think, in fact, the US is in a great situation because they are at the frontier of most technologies. But the politics is where the problem is, and this bifurcation between the extreme Republicans and the extreme Democrats, and the fact that there is no consensus in the middle, means that inevitably you're not going to get the spending changes, you're not going to get the tax changes, you're going to end up with some inflation, and you're going to end up with someone has to deal with the structural adjustment problems. The fact is, bailing out General Motors doesn't fix the problem that the US can't compete with many other countries in terms of automobiles. This whole idea that you want to take all the manufacturing low-skilled workers and turn them into builders in Florida, that's not a policy solution. And so education is a big deal. They've got to deal with the educational problems in the US. At the very elite levels, fantastic, but two of my kids went through US schools. Junior was fantastic, high school was a disaster. And so I think there are some real flaws in the system, and it comes back to the role of government and the role of the private sector. And I think that really, what you need is a couple of states to have experiments whether it be Massachusetts or others, to show how certain types of strategies work and then use that as an experimental design for the whole country. But I'm very optimistic on the US if they can get through the political divide in the Congress. And this election is going to be very interesting. It'll be very interesting to see whether this president, if President Obama wins, he's got some incentive for for not preventing the fiscal cliff, because someone has to hit Congress with a major shock. And I think if the Republicans create the fiscal cliff, they're going to pay dearly for it in the future, because it will cause a severe recession in the US. He's got more incentives of fixing it that way than I think than any other way, but it's complicated.
Okay, I think I'm afraid we're out of time. So I would like to thank you, Professor McKibbin, very much for coming and for sharing your interesting insights with us. And we'll be following your views very closely. Now you're on the shadow board of the RBA, so the students can follow your interest rate predictions and learn about your outlook about the world economy in that way. Thanks very much. Please join me in thanking
Thanks, Ryan.
Warwick for very interesting talk.
Thank you.